You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
Hey, everybody. Welcome back for another spectacular episode of the Multifamily Journey Podcast. This show is especially cool because I got to talk with Ryan Murdock, who's the VP of Acquisitions for Open Door Capital, the company that he and Brandon Turner from Bigger Pockets started that buys and manages mobile home parks. If you listen to Bigger Pockets or even have ever heard of Bigger Pockets, I'm sure that you've heard about Open Door Capital, and Ryan is a big part of that. So this show is not really multifamily focused, but it's commercial real estate, and the principles are very similar. There's a ton of value to be had from this topic. So Ryan breaks down the operational side of the business and how it differs from multifamily and why for them it makes more sense to be in mobile homes rather than multifamily right now. There's a lot of good stuff packed in this episode. I think we had a little network connection problem midway through, so hopefully it didn't cut too much out because the content was just awesome. We talked about setting a clear vision as really the rocket fuel at the beginning. That's your first boost when starting out. We talked about the market selection, the deal screening, the operations, and a lot more. So if you aren't driving, this episode is definitely one to jot down some notes on and come back later and maybe dig deeper into. Ryan puts a ton out there and it's really good information. So Ryan Murdock, like I mentioned, is the VP of Acquisitions at Open Door Capital. He spent 10 years in the electronics manufacturing industry before transitioning to real estate investing and property management back in 2007. He has extensive management experience in real estate, including retail and office, multifamily, HOAs, especially mobile home parks now that they have, I think almost 1,000 units now, including nationwide consulting and turnaround projects with these mobile home parks. So Ryan was a licensed real estate broker for over a decade, now owns and operates his own portfolio of residential properties that's outside of Open Door Capital. And then just on top of all that, he's a really cool dude. And I think you guys are going to see that in the conversation and just, yeah, it's a good show. But before we jump into it, be sure to check out multifamilyjourney.com/podcast, where you can enter your questions to be asked to the guests on the show. I actually read through all of those questions submitted, and I'm working on incorporating a section before the Fortune 5 at the end where I can ask the guests those relevant questions by you guys. So part of the reason I wanted to start a podcast was kind of selfishly wanting to have my question answered. So now I'm going to extend that same opportunity to you all so you can get help with your own stuff, whether it's portfolio or multifamily mindset, whatever it is. So you can put those questions in at multifamilyjourney.com/podcast. And feel free to check out the rest of the site if you want. It was built to be a valuable resource for you all. It's with the free active investor toolkit and the free passive investor toolkit and all the little blogs. So that's all at multifamilyjourney.com. But that's enough of that. Let's get into the show. All right, Ryan, welcome to the Multifamily Journey Podcast. It's awesome to have you here.
Hey, good afternoon, Blake. Thanks for having me on. Really appreciate it.
Yeah, awesome. Well, why don't you start out by giving people a little bit about your background and we can get into things.
Sure thing. My name is Ryan Murdock. I'm currently the VP of Acquisition for Brandon Turner's Open Door Capital, which is a company that buys and owns and operates mobile home parks all across the country. So we're owner-operators. We don't just flip them. We're in it for the long haul. We raise funds through a 506c fund where we raise investor capital to buy these parks. But the 10 or 12 years running up to my role here at Open Door Capital, I worked in the semiconductor manufacturing industry for about 10 years. And when I came to the realization that I was not cut out for corporate life until I was, 60 plus years old and retirement age, I started looking around for things that would allow me to attain financial freedom a little sooner than that, and fell into real estate. So in 2007, I bought a duplex and house hacked that. I lived in one side and rented out the other, and slowly but surely kept adding properties to my rental portfolio. I'm up now to, I've got around 50 or so doors of small multifamily properties myself, in addition to what we do for Open Door Capital. And
so you're house hacking before house hacking was a thing.
Yeah, I think it's always been a thing. Just Brandon Turner put a flashy name on it and and sold some books and really pushed that strategy. And it's a wonderful strategy. I know you're a big fan. You're living it right now, I believe.
Yep, doing our second one right now.
Great. around the same time that I got my start doing that, I also started a property management company, grew that to a couple hundred managed units, and then I got my real estate license as well. So I was a broker for about 10 years. So, a lot of hustle, a lot of different income streams, a lot of, a little bit of this, a little bit of that, all centered around real estate. With the main goal is to hit that financial free number where I could quit my day job. A quote unquote passive income, although I don't know if it's ever truly passive income of rental properties. And then, just to have some more freedom to do what I want. Both
spend some more time diving and surfing out there in Maui.
Yeah, you got it.
Very nice. Well, there's a lot of good stuff packed in there. Property management, small multifamilies, doing it yourself, and now operating what's beginning to be a very large portfolio of mobile homes. And want to get into all that, but today's kind of an episode of the operation side of multifamily or mobile homes, really commercial real estate. So I think people are going to get a lot of value out of this topic. And I've heard Open Door Capital speak about kind of this clear, compelling vision that's really helped you guys grow and scale and blow through a lot of the progress that you guys have had in the last year to 2 years. Can you speak to what that means for you guys with your clear and compelling vision? Maybe just an example of years that you use at Open Door Capital.
Yeah, sure. And I'll give all the credit here where it's due, and that's to Brandon and his ability and just his kind of visionary role in the company. And he goes so far and went so far as to actually write out that vision. It was early last year. We were flying back from a conference, and he wrote out on that flight. It was like a 7-hour flight. He wrote out his vision and actually had the thing printed out, and it's hanging on the wall in his office. And it looks like a giant newspaper article. It's like 3 feet by 2 feet laminated thing, and it's called the $50 Million Surfers. And it's written from the perspective of a reporter doing a story on Open Door Capital at the end of 2021. And by that point, the $50 million surfers had amassed this $50 million portfolio of mobile home parks. But aside from being good at business and being successful entrepreneurs, it was a lot of it was focused around just maintaining a good quality of life. So not necessarily working 60 or 80 hours and burning the candle at both ends. There was a good balance there between that work-life balance of being successful financially, but also getting out in their mandatory surfing time and getting out of the office and doing fun things and having 5 or 6 key people in the organization that were all rock stars in their own separate roles, but also a great cultural fit group wise where everybody went out and had a good time together. And that's really what has happened. And I attribute that to having that clearly defined vision, those clearly defined goals, where we are on track to hit that $50 million goal probably by the end of this year, if not then early next year. So almost a year ahead of what he had written out as a goal. And at the time when that goal was written, I looked at it and was like, man, this is
that's like massive. Now you guys are just absolutely crushing it.
This is crazy talk, but let's try it. and it's not crazy talk because we're almost there. So I think if you set even sometimes crazy goals, even if you fall a little bit short of those goals, it's still a pretty impressive accomplishment. And that's what we're able to do. And we've also been able to build out a team now. We've got 8 or 9 people on our team, and they're exactly what the vision had looked like, where they all excel at their individual technical roles, but they're a great group of people, and we have a lot of fun hanging out.
Yeah, that's awesome. It's really like the lifestyle's built in, the values are there within the group, and it seems like you started with the end in mind and had a really clear idea of what that looked like, and then said, okay, let's break it down, let's break it back. And it's really inspiring to see. You start out with these big, audacious, hairy goals that seem like they're way far off in the future, but if you start with that end in mind and work your way backward, you can attack each day. It's awesome.
Yep, exactly.
Yeah, you talked about the team in this Open Door Capital team and how you guys have grown. How have you built the team to match those goals? So that's one thing that I always find interesting, is how do you keep that vision the same as you begin to see the progress and grow?
Sure. I mean, we started, it was just under 2 years ago, and it was originally just Brandon and myself. We were doing everything. We were trying to source the deals. We were underwriting. We were making the cold calls. We were doing the due diligence,
which is where a lot of people start, like just being the
sure. Yeah, no, absolutely. And what I've quickly learned, and kind of looking back over my 12-year career on my own, if I had implemented a lot of the things that we do now, if I had done those things earlier in my career, I would have been a lot further ahead personally with my own portfolio. And I attribute that to just the power of partnering with the right people hiring the right people at the right time, which can be a scary thing. If you're taking a leap forward, with salaries and extending yourself financially to hire people, there can be some anxiety there for a lot of people. There certainly was for me early on. Like, oh my God, can we afford the salary? Like, it's going to justify it. But what I've learned is when we have the right people in the right places, not only do they cover their salaries and their costs, they exceed expectations.
Help grow, yeah.
Yeah, and help grow the company well beyond that. So one of the ways that we were able to successfully bring in people to help was we've got that luxury of Brandon having a huge audience, whether it's through the Bigger Pockets podcast or Instagram. So anytime we need help, whether it be human resources or raising money or anything, I mean, he can just put a post on his Instagram, which is what he did for a couple of positions where we had just tried out. We were going to intern a few people, and we were overrun with hundreds of resumes for people that were responding to really an unpaid position. Some of it might have been commission based, depending on the role, but really these were very intelligent, very well educated working professionals for the most part. We had some MBAs, PhDs, like data scientists, like some hardcore, like number crunching people that were applying to work for us really for free, but in exchange, they wanted to work with our team. They wanted to learn what we could teach them about real estate and building a business, because maybe they had a great paying W-2 job and a really specific skill set, but they were real estate newbies for the most part, and they were trying to get into it. So in exchange for their time and their talent, they got to work with us. So it was a great way for us to bring on some interns, and from those interns we brought in, there were a couple of them that kind of rose to the top and did more than they were asked, and we're always like, if there was a problem, they always seemed to be the one to solve it. So two of those guys, Mike Williams and Walker Meadows, work for us now full time, and they had interned for us for a better part of a year before we were at the point where we could offer them a full-time role, and that they were secure enough to leave their good-paying W-2 job. So it was a great way for us to kind of work with them to work with us, and feel out that relationship, both personal and professional, and see if it was a good fit. And it was, and we could both take it to that next step with a full-time hire with confidence. And you don't always have that luxury. I know I've done a ton of hiring and firing in previous roles, both within and outside of real estate, and it's always a crapshoot, or seems to be. No matter how much effort I ever placed on interviewing people, vetting references and really digging into their background, there were certainly people that I hired that I thought were going to be a perfect fit for the role, and they fell flat. And then there were other people that I was kind of on the fence maybe about hiring, but did anyway, and they turned out to wildly exceed expectations.
Yeah, well, what a great way to start people there. Out. Like what a
yeah. So it's
what a great way to start, like
dating before marriage.
Yeah, exactly. Just lining your goals up front and just letting the relationship kind of before you make really those financial commitments, like paying the full salary or anything, you kind of get that test run. And you can do the same with partnerships as well. So I think
sure.
To grow the team. And that's awesome. So now you guys are looking at these really big mobile home parks, 100 plus units. Am I right? It's all
right. Yeah. 100 plus units at this point.
Yeah. So when you guys are starting out saying, okay, we're going to go from, having our small multifamily portfolio or a couple apartment complexes, how do you overcome that fear and hesitation involved going big? Like you personally seeing that big number and just striving for it.
Yeah. Darren Sager, came up with one of my favorite quotes. And it's like, don't be afraid of commas, right? I mean, it's really the same process, whether you're buying $100,000 deal or a $10 million deal, for the most part. And that's what we saw when we're scaling the mobile home park business. Is we even originally had started out with much smaller criteria, because that limiting belief or that fear, whatever, that we started looking at just 50 lot parks, and we're looking at stuff with private utilities and a few other things, and we're just quickly just overrun with leads and really just kind of drowning in the workload of trying to sort through all these leads, and which is we're doing a good job with anything overall. But as soon as we honed in that criteria and said, look, we're gonna only target things that are 100 lots plus. We only want public water, public sewer, and then that eliminated like 80% of the leads that we were otherwise just wasting time on. So
so you got to focus in.
Yeah, so it was focused. It was refine the criteria and target things that are bigger, and that really allowed us to excel. With our underwriting, with our offer process, with everything. As soon as we honed in that criteria a little bit, and now we're at the point where we may even increase that again. Whereas, we're looking at, it really takes, like I said, the same amount of work. If we're buying now a $2 million park or a $10 million park, it's the same process really to get it there. It's the same amount of hours, the same amount of aggravation, same sort of problems. They may have bigger dollar amounts attached to them, but it's really, it takes up the same amount of bandwidth. So, we would much rather do fewer larger deals than a whole bunch of smaller deals. And that may be where we're headed in the future.
Yeah, I like that quote a lot that you said from Darren is don't be afraid of commas. I think when people first get into multifamily or any large commercial real estate, they see like the price tags that are involved and say, I could never do that. I could never raise that amount of money. I could never put that amount down. When you realize it's the same process, whether it's $100,000 or $1 million, it really, I think it's just, it breaks it down to a limiting belief. And with you guys, it helped you focus, right? You cleared up a lot of the mess of all those smaller deals with all these different criteria and just got to focus in. And it made it so much easier because like you're saying it, you can do one deal and get the same results of all those other little deals. So that's really good, I think.
Yep, exactly. But
I
would caution, I want to throw in the footnote there that if you're a new investor and you've never purchased anything and you're just getting started, I wouldn't recommend going out and buying $1 million commercial property. Like,
that's also a good point. I always tell people like getting started, like test out a owner occupied loan and live in a small multifamily property, get to own and operate a few doors, and then test your waters and basically do like scale up. If you're doing 4, do 8 this time, then 8's not that much different from 20, and 20 is really not much different from 50, and so on and so forth. Yeah, I think that's a really good.
I mean, the process is the same with the bigger deals, but the risk is always larger. So if you're just starting out, you don't have any experience, and you really don't have a lot of money, I wouldn't go out, like I said, and buy this huge property that if there's a heating system that fails, and that heating system, because it's a strip mall, is $100,000, and you have no money to fund that. Like, you're going to get in trouble in a hurry.
Yeah.
So,
never use your last bit of money for the purchase.
Yeah, so start with something smaller, and no matter what you buy, just make sure that you're well capitalized and you have enough reserve funds to pay for any kind of surprise. So if you're talking about a single family home or a duplex, I mean, what's the worst that could possibly go wrong there? Probably not much that 10 or 20 grand couldn't fix. And yeah, that's a lot of money. But if it's the matter of keeping your business afloat or not, anybody can pretty much scrape together that money with the beg, borrow, steal. Probably don't steal, but if you got to take a loan or put it on credit cards temporarily, you can do it. But if you're talking about a bigger property and you've got a complete septic system that fails, or sewer lines that or roads that need to be repaved, or something big, and it's a couple $100,000, you're gonna have a lot harder time coming up with that. And if you can't, you could potentially put you out of business. So if you're gonna go after those bigger deals, make sure that you are partnering with somebody, or that you are confident in your own experience level to do that, and that you're well funded enough to do it. If not, if you're just kind of dabbling around or experimenting, stay on the smaller side.
Yeah, I like that. That's really good advice. Have the experience and have the capital, and that's like that. Don't be afraid of with the asterisk.
Yeah, and that's why partnerships are great, because if you're lacking any of those things, you can go out and find partners that have whatever it is that you're lacking. So if you have the hustle and you find a great deal, but you don't have money and you're not confident in your experience level, bring in a partner. Bring in somebody that has some money, that has the experience, that kind of navigate you through this, the sounding board for problems, questions, ideas. But maybe they don't have the hustle. They didn't find the deal. They're too involved with other parts of their life to really want to get too hands on. But make it worth their while. Give them a significant part of the deal, even if you think it's maybe a little inequitable, that you're just getting a small piece of it. But you're learning a ton from that person. You're taking down a deal that you probably wouldn't have taken down otherwise, or had a very high chance of failing on your own. Bring in a partner to offset whatever.
Yeah, absolutely. That's how I got started with my first rehab. I didn't feel confident enough to go take down a hurricane damaged home by myself. And also I was like 22 and just starting out, so I didn't have the money. So it was a necessity, but learned so much through the process. And like you're saying, don't let ego get in the way, right? If you're going to get the experience out of it and still get to do the deal, good deal is better than 100% of no deal. So
absolutely.
Just get it done. Yeah, that's good. So for you guys, we talked about the caution of going too big too soon, but why is bigger better for you guys now that you're up and rolling?
Well, because we've assembled a team that has all those parts that we're missing. So like we brought in, Walker and Mike. I had mentioned Walker's our lead underwriter and director of finance, and Mike is our investor relations guy. But what we're lacking specifically was everybody on the team, Brandon, myself, we've had decades of real estate experience. We own hundreds of small multifamily units, but we didn't really have a lot of experience with funds or syndications. We had participated in some and we're generally aware, but we weren't confident in our ability to navigate those waters alone. So we brought in another partner, Ryan Murdock, who wrote Crushing It in Apartments and Commercial Real Estate. And he's done a lot of syndications, a lot of fun. So yeah, it's a great book. If you're looking to get into commercial real estate, that's one of my favorite books of all time.
I'm in my kitchen right now, so I don't have my bookshelf, but it's on there, I promise.
Yeah, if you're looking to get into that space, but like he was that, he was one of those partners that had one of the pieces that we were missing. So anytime we get out in the weeds and in a syndication question or a fund question, or just need to talk to somebody who's got experience on both sides as a limited partner and a general partner, Brian's our go-to guy. He can tell us that, this is normal, this is what you should expect, this is what you shouldn't expect, it's crazy. Just a sounding board who has way more experience than the rest of us in that asset or that part of the business.
Sweet, man. Yeah, I think that's a good transition point, because really the team had the experience. Brian in commercial multifamily, and you and Brandon the small multifamily side. So why mobile home parks? What makes that so attractive for you guys?
I'll give Brandon credit on that one too. He was kind of on the fence for a while, I think, about what direction he wanted to go. But his biggest thing is we had to pick something and go with it and be good at it. So he could have chosen apartments, which would have been fine, self-storage, commercial, retail, whatever. There's any number of things that we could have done and been successful with. But because he just wanted to do and become the best at that, he chose mobile home parks. And there's a lot of reasons that we like them specifically. Personally, I think they're the best asset class to be investing in right now. Not to say that other ones are bad, but our specific strategy centers around value add in mobile home parks. So our ideal park, let's say, is 80% occupied. So we'll find a 100-lot park that is 80% occupied. So there's 80 lots that are occupied. There's 20 lots that are vacant. And we'll buy that park based on its current value, on its current NOI with those 80 lots that are occupied. And if we never do a thing to that park, it will cash flow and it'll sustain itself indefinitely. So we buy it at its current value. But what our appeal to the park like that is that we're interested in those 20 vacant lots. And we want to fill those lots. So if you take an apartment complex, for example, and you want to add value, the easiest ways to do that are just to raise rents across the board if you can do that, the market justifies, or you're going in and renovating units. So either you're evicting tenants or you're waiting until they move out and you're going in, you're spending 5, 10, 15, 20 grand per unit to renovate them. And then after you're done, you can justify a rent increase of whatever it is, $200 or $300 a month. And if you can get it and that works, great. So, nothing wrong with that strategy. Big fan of apartment investing. But with mobile home parks, when we fill those vacant lots, it's a little bit different in a sense of what it costs us and what our return is. So the easiest way to fill a vacant lot is to have a tenant bring their own home in and set it up. They pay for their home to be moved in, set up, and all of a sudden they're paying you lot rent and things are great. That doesn't happen frequently enough that we can bank the whole strategy on tenants moving their homes in. So generally what we'll do is go out and buy either new or more likely decent used homes, bring them in at our cost, set them up on our lots, renovate them, get them turnkey. We want good quality homes going to these tenants. We want them to succeed. And let's say we have $20,000 into getting that home in and preparing it for sale. Our goal is not so much to make money on the sale of the home, although we do frequently. If we can sell that $20,000 home for 25 grand, fantastic. But even if we break even or maybe even lose $3,000 to $5,000, we're still happy, because what happens is once we sell that home, the tenant now owns it. They're responsible for their own repairs and maintenance of that home, but they're paying us lot rent, which is really what we want. Is they're paying us, let's say, $300 a month in lot rent, and almost all of that lot rent goes straight to the bottom line because there's very little expense associated with just the lots. Yes, we're responsible for the primary infrastructure in the park, the water lines, the sewer lines, the roads, the common areas, all that kind of stuff. But still, a vast majority of that lot rent goes straight to the bottom line. So for every lot that we fill, we're increasing the value of the park, depending on the park, 20, 40, 50, 60 grand or more for every one of those lots that we bring in service. So it's a great way to add value to the park with what's already there just being underutilized. So we're not having to build anything out. We're not having to go in and renovate anything. We're simply doing infill for our existing park on our vacant lots and adding tremendous value to the parks.
Yeah, this is so intriguing because, this podcast is mostly about multifamily, but this is really kind of taking that strategy and applying it to a different asset class. value add on commercial real estate because it's valued the same, right? So it's the NOI, and that's what you want to boost to get your value higher. So you guys are just doing that by bringing new mobile homes in and selling them for about what you bought them at, or making a small profit, but it boosts the amount of lot rent you're now collecting at a break even or profit. So your NOI is going up for each infill, which is then increasing the value of that park significantly because you have 20 or more lots that you're filling, which is awesome.
Yep. Yeah, and if we're able to concurrently improve the overall aesthetic appeal of the park, let's say maybe the roads are in bad shape, or it was really, like say it was 50 or 60% occupied, there's a lot of vacancy. Sometimes, the debt on those can be not super attractive, might be a little higher rate, and the term is great. If we can get that occupancy above the 80%, maybe we repave the roads, improve the parking, improve the signage and the overall infrastructure in the park. A lot of times we can do a mobile home park where we might get the occupancy up, improve the quality of the park, then we'll go, instead of selling it, we'll just refinance it. We'll get into some Freddie or Fannie debt at much more attractive terms, pull some cash out if the situation warrants it. But at the very least, we're just refinancing it much better, and then are able to hold it for a longer period of time while we continue to add value.
Yeah, I love that strategy. So it's in all that too, and you don't have to fix broken toilets, or you don't have to do the maintenance of the units because they're tenant owned, which is a big perk to you guys. So when you're looking at your expense ratio on mobile home parks, are they generally lower because you don't have that maintenance expense?
Yeah, and I think it's a little bit of a misconception that they're really hands off. I think a lot of people have gotten into mobile parks saying, "Hey, I don't own any of the homes. This is going to be a piece of cake to manage, and it can be a lot simpler." But generally, when we buy mobile home parks, although we would prefer all tenant-owned homes, that's rarely the way we buy them. There's always some percentage of park-owned homes. So you do have those toilets that you're fixing and some of the interior repairs, but over time, our goal is to push all of those park-owned homes onto tenant ownership. But even then, like it's still, we have resident park managers in every one of our parks that live on site, and then we have our management that's handled by Brian Murray and his wife Tricia. They do a great job running the management company, so they're overseeing all the park managers, and they are very in tune with the parks. They're there on site at the time of purchase, and then they're having weekly or sometimes 2 or 3 times a week calls with those park managers and requesting pictures and videos. So they're still very much in tune with what's going on in the park. But a lot of it just hinges on like how the quality of your on-site park manager. It's the same with apartments, right? I mean, the asset's only as good as the management in place. So yeah, you take a great deal and run into the ground with poor management. So we put a lot of focus there on making sure the right park manager's there, and then we know Brian and Tricia do a fantastic job with the overall management.
There is no better asset class for building wealth than real estate, and in most instances, people don't have the time or energy to invest in it on their own. So how do you build wealth with real estate when you lack the time and energy? Leave that to the GrowthView Properties. The GrowthView team finds, negotiates, and manages multifamily assets for private investors. Their mission is to help investors secure the ultimate asset, which is time, all the while impacting the greater good with their endowment fund that fuels the mission of charitable organizations. Find out more by going to thegrowthview.com. That's view with a VUE.com. Put your money to work so you don't have to at thegrowthview.com.
Yes. Are you guys hiring third-party management for these parks that have an office on site, or are you using somebody that
No.
there? How's that looking for you guys?
Yeah, it's Brian and Tricia's. That was the option to bringing Brian into the fold as part of the team, is not only his syndication experience, but he had also been running his own property management company for a number of years, as he has, I don't even know, 1,000 plus of his own apartment units. So when he decided when he owned that many units, it only made sense for him to build out his own management company and do it in house, which is what he's been doing for years. So that was one of our issues that we were having early on, is we couldn't find consistent third national management companies that we were not comfortable with. And aside from that, it's every market that you go into, you're trying to find a local third party management company. Some markets there's good ones, some markets there's not. And, that would have held us up potentially buying a good deal and just not having anybody to manage it. So
and that's something
Ryan,
we've dealt with too with my syndication group. So I can definitely attest to that. And normally in the multifamily space, you pick a market, you find a property manager that can help you underwrite deals and all that. And if you don't have a good property manager there, like don't buy a deal there because your deal is probably going to go sour. So you don't have to worry about that.
We don't have to worry about it because we've got it. And I think that's a big assumption that a lot of investors make when they're going out of their own market or into any market, where they just assume that finding a property manager is like buying tires for your car. Like there's going to be a solution, and that's not always the case. I mean, there are some great property managers out there, but we have seen markets where there are zero options for quality property. I don't care how good your deal is, if you don't have a good property manager in place, they're going to ruin the deal. So being able to alleviate that entire problem with saying, you know what, we're going to have an on-site park manager. Their responsibilities are limited. They're just doing basic functions within the park. But the real responsibility, the real decision-making process lies with Brian and Tricia, and we know they do a great job. And it's just one thing we don't buy in any market, really, not having to worry about what the potential for property managers are. Now, there's other metrics in those markets that we're looking at. We want a stable population and diversified employment and a few other things. But being able to buy without having to worry about a suitable property manager in that market was a huge hurdle to overcome. It's a big relief now to not have to take that.
Yeah, after kind of hearing that explanation of it, I'm kind of jealous because we've been, as we look for new markets to get into to increase deal flow, it's like, hey, let's find property managers first, because if we really can't fully underwrite a deal until we have the property management, look at the business plan and all that. So that's a great thing for people to think about when they're thinking about which market to go into. And you spoke there about what criteria you're looking at for deals. You talked about can you just talk about that, like how you screen your deals, what kind of markets you're looking at for these assets, and like
sure thing.
Give an example of like where you have a couple parks now.
At a high level, what we're looking for is we want a stable or increasing population, and we've kind of set that threshold that we want to see a population of 100,000 people within a 10-mile radius. If you get much below that, it's really tough. It's hard to find anything. It's hard to find tenants. It's hard to find contractors. We've got the property management piece taken care of, but we still need plumbers, electricians, handymen, that kind of stuff. And if there's nobody around, that can be a real challenge. So the big one's really population. We're looking for more landlord-friendly areas as well. So we'll go anywhere. I mean, July, I did a due diligence trip on 3 parks. Started in Alaska. We're buying a park in Alaska in a couple of weeks, and then next stop was Panama City. We just closed on a park there, and all across the Midwest. So we'll buy anywhere, but we try to avoid states like California can be tough, New York can be tough. Not that we don't like those states; it's just hard as a landlord there. Illinois is becoming pretty difficult. So we try to avoid stuff like that. But we own parks in Wisconsin, Minnesota. I've got a park in Maine still. Like I said, Alaska, Florida. So we're all over the U.S. We're just looking for that the population, diversified employers. We don't want to see just a town that's supported solely by one single employer is scary. If they close up and move away for any reason.
If you lose that employer, you're in a bad spot.
So we try to find a good mix, across different industries and different companies, whether it's manufacturing, healthcare, retail, whatever it is. But we want to see a diversified spread. So if one of those industries fails, the other ones will continue to sustain the area. So that's really it at a broad range. And there's some more. We drill down a little deeper depending on each park, but the population of employers are really the big ones.
Yeah, I think that's really good to go back and listen to. If you're in the position of looking for a park right now, to go back and listen to what Ryan just talked about, what they're looking at a high level, the things that drive these big parks is jobs, population, employment. So those are huge things, and that's cool to find out you guys are in my backyard here in Panama City. I'll have to.
Yeah, man, I wish we did this a couple months ago. I would have stopped by and said hi. But
you guys are in here.
Panama City.
I should. I'll drive through there and just make sure. Hey, paying your rent. You guys better stay.
One of the other things too with mobile home parks, the other thing that we look at, I should mention this, is median income. Obviously, is a big one. I want to make sure that the people make money. That's kind of covered with the employees, but it's the median home price too. So if we see a market where you can buy a 3-bedroom, 2-bath, stick-built home for $80,000. There's not a real compelling reason that people would want to buy a mobile home for not much less.
Yep.
30, 40, 50 grand for a mobile home. But if we're in a market where the median home price for that same 3-bedroom, 2-bath is 250 or 300,000, well, it makes mobile home ownership look a lot more affordable at that $20,000 to $80,000 range. So we think we're going to have a better chance at filling lots where we're not competing with single family.
Yeah, definitely. Because down here by the coast, it's expensive. So mobile homes are definitely the affordable option. I know they're scattered throughout the area, and yeah, there's not many big parks, but with the base here with Tyndall rebuilding, it should be a really good investment for you guys for the future. So excited to see how that one works out. So with this, I was actually just looking at a deal that came across my desk. So it was a mobile home mixed with like some RV lots. Do you see those, and do you see like RVs as the same, or are you, if it has those kind of lots, are you getting those out of there?
Yeah, we've opted not to deal with RV parks at all, and I'm not saying that it's a bad business. It's just a totally different business. It's like kind of like pairing long-term apartment rentals with a motel. Okay, I mean you're providing housing, but it's a whole different business model. It's the nightly rental. There's higher turnover. It's an entirely different business, and we decided early on to avoid really any RV component in a park. So if we offered on parks, we purchased parks that had some RVs, and we just opted to discontinue the RV site rental. But if that's a vast majority of the income or a significant portion of the income, probably the deal's not going to work for us. But we may get to the point down the road if we're having trouble with deal flow, or we're getting bored, we want to branch out a little bit. Maybe we'll tackle the RV space. There's a lot of people that do very well with RVs. It's just a completely different business, and at this point, we've opted to stay out of it.
Yeah, I thought that was interesting because I'm looking at commercial properties. I've seen a few of those mixed ones, but yeah, it's definitely very different. Like my short-term rentals operate very different from my long-term rentals, and it's kind of like mobile homes and RV parks, and just knowing the differences there. Yeah. Yep. All right. Well, what advice would you give to others looking to get into mobile home park investing? What are some like things they need to know before even deciding if that's something they should do?
Yeah, I would educate yourself. Listen to as many podcasts. There's a few books out there, but really, it's underwriting. It's evaluating the deal. They can be a lot more difficult to analyze than apartments. Not that necessarily more difficult. There's just a lot more components. Whether like we had already talked about, what's the percentage of tenant-owned homes? What's the percentage of park-owned homes? If they're park-owned homes, you plan to keep them that way? Do you want to own or operate? And you can actually maybe make some more money with park-owned homes because there's more rent, and you're going to be doing all the repairs and stuff yourself because that's what you've chosen to do. Or do you want to take those park-owned homes, convert them to tenant-owned homes, and what's the plan? What's the timeline for that? What do you have for vacancies? And what's the plan to deal with those? Are you buying homes? If so, how are you financing those? Are you going to be able to sell them for a profit, sell them to break even? You're going to accept losing some money to activate the lot rent. What's the condition of those vacant pads? Can you just drag a home right in and set it up on top of the pad and you're good to go? Or do you need to rebuild the entire pad? Is there going to be a foundation required? Or do you have to at least bring in gravel and rework the lot? What's the condition of the water line, sewer line, electrical connections? It might take you 10 or 15 grand to prepare that lot before you can even bring a home in and set it on there. So there's a lot of variables, and you want to make sure that if you're looking at buying a mobile home park, you're accounting for all of those and you have a plan to deal with them. And it's going to be different for everybody depending on the situation. And we're pretty dialed in on how we proceed with things, but even that can vary depending on the market, depending on the demand. So, this is my answer, and we had touched on this already, but probably partner with somebody on a park, either even if it's not to purchase a park with somebody, but to help them out, work in and around the mobile home park, whether you're helping them do cleanup or you're renovating homes, or maybe you're taking on some management duties just to kind of learn your way around a park. Because chances are, if you've never been in one, you don't have much experience, you don't even know what you don't know from an operation standpoint. So, maybe dedicate some of your time, even if it's not for money. Partner with somebody, align yourself with somebody, help out, 6 months, 12 months, whatever, and you just get a better handle on your own park moving forward if you choose to buy one.
Yeah, I love that advice. Figure out what you want to do within the space, because like you said, there's a lot of different routes you can go. So just knowing those differences is super important. If you jump in and don't know what a park owned home is, or a tenant owned home, or a owner occupied home, then that's going to be a big issue. So yeah, that's good advice. So Ryan, let's transition now to the Fortune 5, the 5 questions I asked every guest at the end of the show. So let's kick this thing off. What's the biggest thing that has contributed to your success so far?
my persistence. I look back at all the bad decisions and mistakes I made, and just so many times that I wanted to quit and say, this is just not worth it, man. This just sucks. But get up, brush yourself off, keep going, and persistence. And I continue to try to minimize those mistakes, and that's why I hammer so hard on partnering with other people or being around other people that are doing what you want to do, because none of us are going to make a mistake that somebody hasn't made before, or have a question that has gone unanswered somewhere. Like there's an answer for everything. So the more you put yourself around other people, the more you can minimize those mistakes. But you got to make mistakes. Like I don't know anybody that's just started in real estate investing and hit home runs all day, every day, all the way through. There's going to be challenges. I know I had a ton of them, and just persistence allowed me to just keep going through them.
Yeah, that's super good. You got to learn how to just take it on the chin, keep going. Mm-hmm. What's been your biggest mistake so far that's turned into a learning lesson?
It's going into a deal undercapitalized, and I touched on this already too. Is I bought some properties early on, and I thought I was going to kind of hit the ground running and get into them with no money down, and they were going to cash flow and things are going to be great. And I just got hit with one surprise after another. And looking back, all of those surprises should not have been surprises if I did sufficient due diligence and I was more attentive. But it was more of I didn't know what I didn't know. Got into these properties and ended up spending way more money than I had. I was borrowing and stealing. Well, I wasn't stealing again, but putting on short-term debt, credit cards, and doing all kinds of things. It really took me years to dig out of, and nearly lost all those properties, and took, I almost lost everything, my entire business, because of those, because I was throwing all the money at these properties that to fix these surprises. So make sure you're well capitalized, whether you're buying a duplex or a shopping mall, whatever it is. Make sure you have enough cash on hand to deal with surprises, and try to minimize those surprises up front.
Yeah, so important. It goes back to what you're saying about diligence. Like just kind of try to figure out what you don't know before you get into it. Talk to the right people, partner. I mean, you can avoid a lot of mistakes. There's so much information out there that you don't have to go make every mistake in the book. You can listen to podcasts like this or go to Bigger Pockets and connect with and read through those discussions. So kind of good information. But that's a good mistake. I think a lot of people benefit from hearing that, right? Ride the curtails of people that have went before you, right? You don't have to make all the mistakes yourself. So that's really good. So Ryan, what is your favorite real estate resource you'd recommend to someone starting out, whether it's a book, a blog, website, whatever?
Yeah, Bigger Pockets, hands down, whether it's the Bigger Pockets forums or the Bigger Pockets real estate podcast. I mean, it's over 400 plus episodes now, and it's so diverse and so varied. So whatever it is that you're looking to do there, I'm sure there are multiple episodes around that specific niche. And if you don't know what you want to do, just start with the podcast and just start listening to them. If you listen to all 400 episodes, you're going to be better educated than most of the actual real estate investors out there. I mean, there's just so much knowledge there. So, I know for sure when I started listening to Bigger Pockets podcast, I'd been a real estate investor for 7 or 8 years and was doing what I was doing, but there were all kinds of strategies, all kinds of things I had no idea even existed, at the time, syndication, subject to, and some direct mail strategy and off-market deal finding and all this stuff. So if you don't know what you want to do yet, listen to that and figure out what sounds appealing, what sounds like it fits your personality type, your budget, your market, whatever it is. And if you're already an active real estate investor, maybe you'll learn some new things, find some new avenues, new things to target. I know I certainly.
Yeah, super, super good advice there. And that's why I kind of wanted to bring something a little bit different on this show, talk about mobile home parks and the operation of scaling that business, because it gives people a little bit different view and the things that are possible and what else is out there. Maybe, multifamily is too crowded and mobile home parks is the way to go. I don't know, but providing the information for people out there, and Bigger Pockets is definitely a great place for that as well. So Ryan, we talked about this a little bit before we jumped on, but what do you like to do outside of real estate and buying a bunch of mobile home parks?
I scuba dive as much as I possibly can. So I try to get out there 3 or 4 times a week. We did a 3-tank boat dive yesterday. I live in Hawaii, so it's a great place to have some easily accessible shore dives, boat dives, all kinds of cool stuff out there to see. So I'm in the water, under the water as much as I possibly can be.
Yeah, super jealous. I need to get out more in the ocean here. We need to make some more beach trips for sure. This has been awesome. The last question of the Fortune 5 here. Where can people find out more about you or connect with you?
Sure. You can hit me up on Instagram. I'm at ryan.murdock21. And you can go to our website, opendoorcapitalllc.com. You can see my bio and everybody else on the team. And I will pitch one more thing. We're in heavy acquisition mode right now. So we're putting a strong focus on off-market mobile home parks. So we are offering a $100,000 finder's fee to anybody that brings us a warm introduction to an off-market park. So this is not like a wholesale situation where you've got to put the park under contract and negotiate a price or any of that kind of stuff. All we need is for you to introduce us to a seller, either over the phone or through email. We'll take it from there. And if we close on that park, we will write you a check for $100,000 and we'll be thrilled to do it. So it's got to be an off-market park. So don't send us, LoopNet listings or any of that. But off-market, go to bringbrandonadeal.com, and there's a short list of questions that need to be filled out and answered. Submit your lead there. And like I said, if we buy that park, we'll pay you $100,000.
And I like that. I think this weekend I'm gonna go spend some time driving for dollars around Panama City.
There you go, man. We especially like Panama City because we already have a park there. So yeah, any market that we're already in, we're even more inclined to try to buy there because
I actually know a mobile home park owner that owns a 100+ unit park. I don't know if this
get on it, man.
So might have to
get on it. Bringbrandonadeal.com. Sling it in there.
I'm gonna bring Ryan a deal. Bring Brandon a deal.
Yep.
Say that 5 times fast. Awesome, guys. We'll definitely go check Ryan out and check them out online. They're doing awesome things. If you're interested in mobile home parks, Ryan, thank you for coming on the show. This has been awesome. Provided a ton of value of just the operation, which is really applicable to all commercial real estate. But you guys are killing it with mobile home parks right now. So I think this is a very good value for the listener. So yeah, thanks for coming on.
All right, man. Thanks for having me on. This is a lot of fun.
All right. Have a good one.
Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. And if you want to check out more on your multifamily journey, go to multifamilyjourney.com where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.